How did you? I see you know everything. Like from the beginning.
All right, so from day one, I knew. Like, we were dating all 15.
No, that's a funny mouth.
On 15.
Not funny mouth.
Around. It was hard for me to like go to the
Yeah.
Hold on.
It was her and nothing.
Good afternoon.
Y'all know
Okay, hello, hello, hello. Can anybody hear me?
Yes.
Good afternoon.
Good afternoon.
Afternoon, everybody. Let's give the others a few more minutes before we begin. Okay, let's see. I see Indira, is that you?
Yes, sir, that's me.
Wonderful, wonderful. And Javon,
Yes, sir. I'm here.
Javon, did you send me any paper in my email?
Should I send you a paper in your email?
Yes.
I should have.
What were you supposed to send me?
The midterm.
You mean the makeup?
Yeah.
Did you send it?
I did Saturday.
I may have missed it somewhere, perhaps. But what I need you to do is to resend it to me.
Oh, okay.
Okay, so you can get the appropriate credit. Okay?
All right. Okay.
So Javon is in the room. And then we have Shaniqua.
Yes, good afternoon.
Afternoon, Shaniqua. How are you?
Pretty good.
Okay, I'll go with pretty good. Brian.
Yeah, I'm here.
Hi, Brian. How are you?
I'm doing well.
Hey, very, very nice to see the guys in the room. Guys have a tendency to back off, skip out, find other things to do. So congratulations to you guys. You're hanging in there. That's the way to go. All right. Let's see. Monique.
Good evening.
Hi, Monique. How are you?
I'm good.
All right. We have 5 people. We have
Sorry?
I'm just saying we have enough people to get started, so let's go.
Okay.
Okay. A little bit of housekeeping before we begin. How is the case going, everyone?
Almost done.
Okay, that's the start. Javon is almost done. Anybody else?
It's going all right.
Okay, okay. And for those who don't say anything, I'll assume you haven't started yet. Is that a reasonable assumption?
No, it's coming along. It's coming along.
Fantastic. All right, good. Remember you have until when to pass it in?
Would that be next class?
The last class, week
You have
12.
until the last class,
The last class, week 12.
which is
So
when?
that's week after
When is-
next.
Yeah,
The
that's
17th. Yeah.
April the 7th.
So this week here is no class, right?
Which week?
The holiday.
We have holiday?
Easter.
Monday.
Easter
Yes,
Monday.
we do.
Yeah. Easter Monday.
Holidays don't apply for students. That's for high school. That applies to adult students too.
Yeah.
Yeah, it does.
The only problem is if we have a holiday, then we are going to not be able to cover our final lecture, which is not good. Or we'll have to reschedule it like for Tuesday. Would you'd rather wait until Tuesday evening rather than do it on Monday evening?
No, Monday. I mean, I don't have a problem with it being on Monday. I just was asking. I wasn't sure if
Yeah,
there was another class.
yeah, there's one more class, which is the holiday Monday, but you know, we all gonna be somewhere hanging out, so
Right.
someone just
Mm.
for about an hour and a half or so. So we wrap it up and then you can be off and running to whatever else is on the agenda. Okay?
Okay, and the week of the 17th is what, our exam?
Yes.
What?
17th is your final exam.
Oh, I'm scared.
That's again pushed back to the 24th, seeing that we missed last week's class and then a holiday.
I think that's why it's not all in there.
We're gonna be here on a holiday.
We're gonna be here.
What?
Huh?
Yeah.
I have corrected tickets, Mr.
Yeah.
Wilkins. Mr. Wilkins,
So what?
Arithmetic.
corrected tickets.
Ticket?
Yeah. I think the evening session starts 6 or 7.
6:30. Same as now.
Like Mr. Wilkinson has tickets too.
If you have a ticket, carry your computer and log in.
Probably. Oh boy.
How about that?
You
How
trying to
about
get
that?
rid of us already?
Don't let a ticket slow you down.
Oh, boy.
So if somebody's, if you're traveling somewhere, carry your computer with you and log in. Whatever you're doing, tell them, hold on, I have to log in for an hour and I'll be back. That's how you do it as a student. You don't let anything hold you back. Because at the end of the day, whatever it is, it's not going to help you through what you need to do. So yeah, if you have to do ticket thing to carry your computer when 6:30 roll around, stop everything. Stop whatever you're doing. And then after an hour or so, then you can say, okay, I have enough to go and prepare myself for my final exam. And then somebody might say, what are you doing? Are you losing your mind? I said, no, this is what students do. And they'll look at you funny, but that's okay. All right. So those of you who are going to be home just doing the normal stuff, log in at 6:30. If you have a ticket, log in at 6:30. By hook or by crook, we're going to finish our discussion on ethics next week, because that is a very important topic. I wouldn't say we might necessarily get through the whole module, but we'll get through what I need you to get through as far as understanding.
Well, Mr. Wilkinson,
Question.
were you suggesting another class? Or having doing it another day? You said something about Tuesday?
Do we just keep trucking,
I
no matter what?
thought I heard Tuesday somewhere. I don't know if
Sorry?
it was tomorrow or next week Tuesday or no, that would not work.
Well,
Or Wednesday or no.
you would have to get the majority of the people to go with you, like in a board vote.
Oh, we can let's have a vote
Okay?
another day. It doesn't have to be Tuesday, maybe Thursday.
Well, it'll have to be on Tuesday because I have a lecture on Wednesday and Thursday.
Okay. So
So
Tuesday that'll be
Monday,
the 11th.
Tuesday. That's when you guys want to do it. That's Tuesday the 11th.
What say you?
I have no issue.
No issue Javon has. He can
Okay,
go.
that Tuesday's fine with me too.
Who said that?
Monique.
Monique spoiling the whole thing. That's fine with me too. Okay, we need at least 3 people. That's 2. 2 will not do.
We will not do.
Okay. Going once, going twice, going
Okay, I
thrice.
tried.
Yeah, you tried.
I must have got my phone on the bleachers then.
Tuesday.
That's okay. Whatever the hell you have to do, run up somewhere in the corner, look with one eye at whatever, the other eye at the class.
Okay, all right, all right.
Also, remember next week we'll be talking about the document, the module I sent you on ethics. So, of course, if you're going to be blah blah blahing along the way, you might want to do some reading in advance before Monday, so that by Monday, since you might having to multitask or whatever's going on you would at least have an idea and make your life a little bit easier while the rest of us plod on. Okay? All right. Fantastic. So make sure, if you finish your papers before the 17th, you are free to pass them in. Make sure you have your names on the papers that you pass in so that I know whose papers I'm looking at. If you send me a typewritten document without a name, then I have to go through some major process of elimination to find out whose paper it is. All right, so please put your name on each piece of paper. Okay, whose name I didn't call on this list? I think they called everybody, Letitia, Brian, Siobhan, Indira, Shanika, everybody's here. All right, the other thing is, around 8 o'clock tonight, I understand that BEC is going to be working in this area, which means that one or two things will happen. If you don't hear me 1 minute past 8, what happened?
Your internet went up?
The lights went out.
That too.
Yeah. So I don't have any guarantee as to what they're going to do. It's just a notice saying they'll be working in the area. We don't know who's going to be impacted. So it is very likely that lights will go out for some period of time around that time. So what I need to do is get in as much as I can get in before 8 o'clock so that we can break around the time so they don't shut me down in the middle of my discussions. All right. So if we're approaching 7:45 or something and I'm still like, I don't want to quit, somebody could remind me the 8 o'clock thing, and then we'll finish up next week when we come, if we have anything that we haven't done today. Okay, so just putting you on notice, it's very possible that they may do some nonsense a little before. I don't know what they're gonna do. So if I'm talking and then you don't hear me anymore, hopefully I didn't die. The lights just went out. How's that? Okay, and then of course we'll pick it up. We'll pick it up next week and finish up. In the meantime, just a reminder about something you already know, please don't wait until the last minute to begin reviewing. Start early, start making your important notes, start making your study notes early, and start reading them and trying to remember the important stuff. So you don't find yourself hustling around at the last minute trying to recall. And it becomes frustrating, and then there's a big fight on your hand with yourself. Okay? It's always better to start early. Did everybody send their makeup exam in, those who wanted to send it in? Okay, fantastic. Okay, Siobhan, don't forget, that wouldn't have been your fault. I probably missed it somewhere for some strange reason, but do go ahead and resend it, okay?
Okay, I won't forget.
Okay, fantastic. So let's go to the verification and valuation and get right into it so we can make the best of our time. Does everybody see that? Verification, valuation of assets and liabilities? Yep. Let me know when you find it. Yes, yes, yes.
Yes.
Okay,
Yes.
great, great, great. Now, first of all, let us establish something here for the purposes of our discussion. We need to define what an asset is and what a liability is. Does anybody know? Anybody knows what an asset is?
Outside of stuff that you own,
Yes,
liability is stuff that you owe.
absolutely. An asset is anything that you or a company owns. A liability is anything that you or a company owes. So if you owe somebody money from 5 years ago, you have a liability. If a company owes the bank, they have a liability. If the company has equipment and machines and inventory, they are assets because they are owned by the company to do business. If you own a house and a car or something of that nature, a Rolex watch, whatever it is, then those things are assets. Okay? So it's very important to know the difference between the two. And so when auditors come into your organization, or if you're an internal auditor now or one day in the future, when you go to verify, verify has a very specific meaning. Can somebody Google verify or verification and tell me what Google says? What is the meaning of verify?
Make sure or demonstrate that something is true or accurate.
Correct. So when the auditors come in, they don't take your word for it. They're gonna go to the asset accounts in the general ledger, and they're gonna go to the liability accounts, and they're gonna check for themselves to make sure that the information that goes in or went in is true and correct to the greatest possible extent. Okay, very important exercise. Part of the reason people make errors. So if the auditor finds it, they can correct it. The other part of the reason is people defraud companies. So employees are oftentimes looking for ingenious ways to get money out of the company, steal, defraud the company. And so what they tend to do from time to time is find ways to falsify documents, post incorrect information, record incorrect transactions. All of these are designed to ultimately get money back into the employees' pockets. Okay, unfortunately. And so this verification process by the auditor is to check to see what employees are doing. Did they do it correctly? Do we detect any fraud of some kind, any wrongdoing, or are these errors really just truly errors? Because you know by now that some errors are normal human errors, and others are deliberate. Because they're not really errors, they are fraudulent behavior. Okay? And auditors are always very keen about this part of the verification process. Okay? So basically, it's to check. It's to inquire, to find out if something is true. And in the case of assets and liabilities, you're looking at the value, ownership, and the existence and possession of any assets and liabilities in the company. Why do I say that? Because sometimes the financial statements have information on the statements, and when you check to see if they exist, they're not there. For example, it might have $5 million worth of machinery, and the auditor says, I need to verify that the machinery is there. And suddenly they can't show you the machinery because it doesn't exist. So existence is a very important part of the audit process, because all kinds of strange things going on. Some companies, they might go and borrow the equipment until the audit is over. They may not own it. They may go to a colleague and say, lend me your $5 million of your equipment so I can show my auditors, and then when its audit is over, you can have them back. Which means that the company does not have possession, which is why auditors have to check possession as well. Because existence, meaning it's there, doesn't mean possession. How about that? It could be somebody else's assets that you're using to give the auditors the impression that you have them, when in fact you don't own them. And the only way the auditor will know if you own them if they ask you for the necessary paperwork to see if you actually possess those assets, and in some cases, liabilities. Okay? So verification is crucial. It's about the auditor satisfying him or herself about the existence and accuracy of the information in the asset accounts and the liability accounts that appear on the balance sheet. And how do they do this? They physically inspect the documents. They physically inspect the documents that were used to purchase and incur assets and incur liabilities. Right? Then they go to the general ledger accounts and they look at the posting to see if the correct information is posted. Okay? You could look at the general ledger, for example, and see that $300,000 is posted for the purchase of an asset. And then when you go to find the documentation for the asset, you would discover that the asset is really only worth $150,000, which means that the company is deliberately overstating the assets for one reason or another. Okay. So if you're still wondering why the audit process is so crucial inside and outside the firm, internal audit, external audit, I hope you have a damn good idea by now of how critical it is, whether you work directly in audit or not. Because whether you work in audit or not, everybody is impacted by the work of auditors. That's the point. From the board all the way down to the janitor. Everybody is impacted by the work of the audit. Right? For sure. And of course, if your information is going to be believed by the government, by banks, by investors who want to invest money into your business, they don't want to take your word for it, because people lie all the time. Not everybody, but enough. And enough people lie and falsify so that persons who want to rely on the information just cannot take your word for it, because it may or may not be true. Hence the work of the auditor, which is why auditors have to be very careful who their friends are, who they take favors from, because they could be easily corrupted by participating in any of those things. Just remember, like anything else, when folks give you something, they expect something in return. So if the auditor takes 5 nights in Bahama as a gift, that's a spooky position. No auditor should be doing that. Because sooner or later, the company is going to call upon you to look the other way when you discover something in those company records. Okay? So now all of a sudden, you don't see that stuff in the text, but that's the real life side of the work. Okay, which is why we will spend time next week talking about a little bit about ethics, well, what is right and what is wrong, and what is expected from the auditors in doing their jobs, and what is expected by management. Because remember, all the information that the auditor is verifying is being put forth by management, which makes management responsible for their financial statements, their financial activity, their administrative activity, their everything. Management cannot say, I don't know, I don't care, it's somebody else's problem. They cannot. Okay? They are responsible for all the information that is produced within that firm. And that's why when auditors come in, they say, we are here to audit the information as put forth by the management of this company, who is ultimately responsible for this information. We just here to see basically whether it's true or false in any material way. All right. So all that chit chat was about a very important definition called verify or verification. Nice word to know, even if you're not in the audit world. If somebody tells you that something is going on or they have certain things, you could believe them, but the only way you can be completely satisfied is if you do the audit thing, and that is verify. Okay? I have a job, so let's get married. Okay, great. And, I'll call you back in an hour and you go on Google and do a search. So let me see if he really has a job. Okay, that's what verification is all about, testing for the truth about information. Notice we are told that verification includes checking for very specific things. I've given you 4 here to kind of give you an idea of the kinds of things auditors are looking for. Can somebody tell me what those 4 verification items are here? Number 1.
Existence of the asset,
Yes, keep going.
legal ownership and possession of the asset.
Yep.
Ascertaining that the asset is free from any charge and correct valuation.
Absolutely. See that? All 4 of them are very key things. And the reason why they are isolated here is because the assets of a firm represent those things that the firm uses to do its business from day to day. The assets of the firm are reported on the balance sheet that is looked at by investors who put millions of dollars of money in companies, by banks who lend millions of dollars to companies. So this is not a game. Even though some board members and CEOs tend to act that way, like it's a game. But if it's a huge business, multi-million, multi-billion dollar business, it's easy to see why a verification process would cover these kinds of things. Because truth is, many management people of firms lie and misstate financial statements for their own personal agenda, whether it's money, whether to make the company look better than it's looking or worse, whatever the case might be. Okay? These things are crucial to the audit process and certainly to the verification process. All right, now, like everything else, when you're doing test checking, anybody remembers what test checking is? From part one, the early part of the semester, what is test checking in?
An in-depth examination of
Of
the
every-
transactions from beginning to end.
Okay, is that an in-depth check of every single transaction?
No, not everyone.
No, yeah.
Not everyone. What do we actually do first before we check it? We take out,
Sample, random sample.
Samples.
yeah, we take out a sample and then we do 100% test sample.
Mhm.
And if it's 100% testing on the samples that we select, come out reasonably good, then we make an assumption that the rest of it is quote unquote okay.
Okay, yeah.
Okay, yeah. So yeah, you were half and half on that one. Yes, it is 100% testing, but only on the sample. Okay? For obvious reasons, there are too many transactions to check them all. And so here we are again under verification, saying it's not possible for the auditor to verify each asset. Okay, depending on the size of the firm and the type of assets that we are thinking about. For example, let's say the asset represents gold that is in the ground. Well, we can estimate how much gold might be there based on how much gold has been found so far, but there's no way the auditor can come up with a correct determination as to the value of the actual gold. We don't know how far it goes, how deep it goes. You can only do an estimate. Okay, that would be difficult to verify, for sure. Interestingly enough, as well, in a case well known to persons in auditing, we had this situation where a company called Kingston Cotton Mills, it's right there, where it was determined that it's not the auditor's duty to take stock. Anybody knows what take stock means?
An inventory too,
Yeah, to take inventory.
of all the items.
Yeah, to count everything. Anybody in this room ever did inventory?
Uh,
Yeah.
Yes, I
Yeah.
participated in one before.
Yeah, come in your jeans and tennis and count everything. Right?
Pretty much.
Yeah, it's a
Pretty
nice.
much.
Yeah.
Sounds about accurate.
Yeah. All right. So basically, auditors are not coming in to count any inventory unless something specific is going on and they need to do it personally. But typically they don't count inventory. They rely on management to count the inventory and give them the number. Of course, that doesn't mean they won't be doing spot checks and all that kind of stuff. But generally speaking, inventories are not counted by the auditors. And part of the reason for that is, hey, we can't get caught up in that part of the deal. This is your company. You do the count. You give us the information. We look at the inventory and see what you have and make a determination as to whether or not your numbers are reasonable. Okay? And that's where we talk about the judgment call. Okay? Oftentimes, auditors have to make those kinds of judgment calls. So on the one hand, one case says, hey, the auditor doesn't have to do it. And then in another case, the McKesson and Robbins case of way back when, it was ruled that the auditor must physically inspect some of the assets, but just like test checking, see? In other words, earlier we said, they're saying we don't have to inspect anything, we can take your word for it and make a guesstimate of some kind based on the information you're giving us. However, under McKesson, they're saying quite the opposite, that the auditor should and must physically inspect some of the assets, kind of like test checking, to see if you can make an assumption about the total number of assets. In other words, whatever you do, you may not be able to check it all for practical reasons, but certainly always seek to do a sample of, in this case, the inventory. So you can get the comfort and the assurance that basically the information that we're giving you is within an acceptable range. Because if you try to verify 100% of everything, you can frustrate everybody, including your audit team, you as the audit manager and supervisor, and then it just is not going to work. Okay? Without draconian measures, and who wants that? All right. So, okay, man, that was something that wrong already. So, on page 2, at the very top of your notes, you'll see a statement of auditing practices being referred to. And it says that it's the objective of the auditor with regards to assets to satisfy himself, as we said earlier. Remember the first 4? We're just extending it again. But some of the same principles are coming up again in terms of verification of assets. We must prove they exist. We must prove that they belong to the client, especially their big ticket items. See, nobody is going to be concerned if a couple of garbage bins are missing and the printer and all that kind of stuff, depending on the size of the company. But if it is a multi-billion-dollar company, and some serious looking will have to be done. Okay, so they have to prove that they exist. Auditors have to prove that they belong to the client possession and that the client is in possession of the asset, and that the proper persons to authorize and to verify those possessions are in place to answer those questions and prove it. Okay. Also, check to see if those assets do not have what we call encumbrances. Anybody knows what encumbrances are? Okay, Mr. Google, anyone? What are encumbrances?
That's when items are pledged, they or have a, what you call it, they're tied or, yeah, used as collateral, I think.
Yeah, when assets are pledged and used as collateral. That's what the word encumbrances are all about. Okay? So when the auditors come in, not only do they have to prove existence and possession and ownership and all that stuff, they have to find out if there are any loans against those assets or whether they're free and clear. Okay, so and they need to find out for themselves. They cannot just, they could, but they should not just take management's word for it, particularly in key matters involving big ticket items. The big ticket items, and especially, need to be checked because, hey, you don't want anybody run off with petty cash and all that, but that's a small matter compared to some multi-million-dollar piece of equipment that is not really in existence for that company, even though they have it on their balance sheet. Okay. Serious stuff. And then, in addition to checking for encumbrances, you have to verify on the balance sheet that the amounts there are the proper amounts and that they've been posted in accordance with generally accepted accounting principles. How about that? Okay. And then finally, the auditor has to make sure that the transaction itself, after checking all the other 5 items, is actually recorded in the accounts. Because sometimes people could show you everything, and then when you get to the account, it's not posted. And then they try to find and give you a reason other than the truth as to why it's not posted. Now, they say it was not posted because it was an oversight. That may or may not be the truth. What do you guys think? It was an oversight. Do you believe it? Well, would you believe it? It was an oversight. Normally,
What happened?
is that a yes or no?
It could happen.
She's not committing. She's like, don't you get me in any yes or no. It could happen, and I'm sticking with that. Doggone it. Because that's a safe answer. It could happen. Okay? Siobhan and Brian, that's like Indira, will you marry me? And she's like, we'll see. Is that a yes or no, Siobhan?
That is a no.
That's a hard no.
That's a very odd no.
Yeah. Whether it's yes or no depends on who's listening to it, correct? Because
Mhm.
if she says it to a hopeful guy, like who's really head over heels, she says maybe, guess what he's gonna say? Oh, God has blessed me. At least she didn't say,
No.
even though according to Siobhan, for him, you tell him maybe, that's it. You're not seeing him anymore. To him, that is not no stinky maybe. That is no. So yes, it all depends on who you are talking to. Wow, how about that? All right. So this verification process is very crucial. Okay. I was telling my youngest son who lives in Toronto, because he's coming home anyway. I don't know how the hell that happened. But anyway, he's there. And so, and he's 25, so he's on the dating scene, like, dating. And I'm like, oh my God, dating. And so he would ask me certain things. So, Dad, when you were my age, how stuff like that, even though it was different place and time, completely different. So I try to give him the best fatherly advice that I could. Except nowadays, there were certain things when I was 25 that you didn't have to verify. But nowadays, with youngsters in today's world, there's certain things that they meet someone that they have to verify. Is that true or false?
Repeat that against me, please. The phone keep cutting in and out.
Very true.
Yeah, I was saying that if you're dating in the modern society, unlike when I was a youngster, there were certain things you didn't have to verify. But today, there's certain things you have to verify,
Verify everything.
or else. Like, for example, when I met my wife back in the day, I knew she was a girl. But when my son meets a woman today, he's not sure if that's a girl.
Yeah.
That's my point. So now what he has to do? Find a way to
Okay.
verify. You have to conduct an audit.
Yep.
So that means while they're dating, you have to like bump into her accidentally and see if he can figure out whether it's a boy or girl. And even that, because nowadays, not only are men dressed up like women and women dressed up like men, making it hard to verify, but people are actually changing their genitals. So, like, unless you some serious verification, imagine getting married. Just get married. See, verification. And I use that personal example because for two reasons. One, to illustrate the importance of verification, and two, to illustrate the importance of verification, especially for this generation. Oh my God. All right. So they are the key things that auditors will walk into your office very specifically. This is what they prepare as part of their audit plan. Remember we discussed the audit plan? Anybody remembers that? Yeah? No? Anybody remembers anything about the audit plan?
Yes.
Yeah. Well, that's one. 1 out of 6 is better than 0 out of
Yes,
6.
yes.
All right. So moving right along then, more verification stuff, because there's no such thing as I'm bored with verification, I'm tired of verification, I don't like verification. That's the auditor's job. They live and die on verification. Okay? If they do it properly, they continue to be reputable auditors. If they don't do it properly, they'll soon lose their reputation and lose their audit business. It's as simple as that. And God forbid, the companies that they have audited inappropriately will suffer the consequences as well. Okay? So when we are conducting these 6 main key verification steps for assets, we need to keep in mind what we already said. And it's outlined once again, see, same 6, 7, to remind you of how important these points are. I'm telling you now, these points to be considered, they're just screaming to be asked in an examination on the 17th of April. So it will be in your interest to at least know them just in case, because you never know. It will come up. Okay. So when conducting our verification as auditors, again, what should we consider? Existence, we already know. We have additional explanation to help you understand what existence is, whether it exists, whether it's present physically. Possession, verify that the assets are in possession of the company. But if it's on the balance sheet, it actually exists, that somebody didn't make it up. Ownership, make sure the company owns it, not somebody else. Some companies lease assets and try to treat it as if it's their own. When you lease an asset, it's not yours. You can't put it on the balance sheet. At least not in dollars and cents. You have to make a note that you leased it. But you can't put it on the balance sheet under the asset category as if you owned it. Because you don't. But some companies don't mind faking it, especially for auditors who don't check everything or key things. Okay. Change of lanes, check to see whether there are any liens against the property, whether there are any encumbrances, whether the bank is holding it as collateral. Because remember, once the bank is holding it as collateral, then you now have to go and check to verify the liabilities and see if the liability amounts are correct. Okay. Very important stuff, and they all interconnect. Then, number 5, make sure that all the transactions are recorded appropriately. You have a couple of big ticket items, one for 10 million, one for 50 million, one for 100 million. You better make sure that they are posted properly and to the correct accounts. Otherwise, some ill-seeking person inside the firm will find a way to get their hands on some of that. Okay. And then, of course, we have the audit report. And this takes place at the end of the audit after all the verifications have been done. And the auditor says to management, look, we have conducted a physical verification and check of your fixed assets, your inventory, etc. And we are satisfied that all is well, basically, that the transactions have been appropriately posted to the accounts. We haven't come up with any major oversights or defalcations, meaning problems. All right. And then, of course, number 7 is an interesting event as part of the audit check. And so in 7, auditors are asked to consider activities within the company even after the audit is over, up to 3 to 6 months in some cases. Go back to see if there are any significant changes. Because if there are significant changes a month later, a week later, a day later, the auditor can then draw the conclusion that perhaps those changes took place because there's something in the audit period that they didn't tell us. Or there is something seriously wrong with the company. So this process is absolutely crucial. Events after the balance sheet date. Anything significant happen? Did the company get rid of 50 million or acquire an extra 50 million shortly after the audit? Those things will be red flags for the auditor. And so they're coming back to check to see if they covered all of the relevant ground. And that nobody is hanky-panky. All right. So let's see who's on the top of my hit list today. Well, looks like Letitia is always on the top of my list first. Letitia, are you there?
Yes, I'm here.
Okay, Letitia, why don't you pick up from scope of verification?
Scope of verification. Verification includes obtaining information on the following: that the assets were in existence on the date of the balance sheet, that the assets had been acquired for the purpose of business only, that the assets had been acquired under a proper authority, that the right of ownership of the assets are vested in the organization, that the assets were free from any charge, and that the assets were properly valued and disclosed in the balance sheet.
Before she goes on, let me say this. As she's reading, or as we're talking, if you have a question, please interrupt me, interrupt her, interrupt whoever. Get your question answered so we can move on, okay? Don't be bashful. All right, keep going, Letitia.
Objectives of verification. Following are the objectives of the verification of assets and liabilities: to show the correct valuation of assets and liabilities, to know whether the balance sheet exhibits a true and fair view of the business, to find out the ownership and title of the assets, to find out whether the assets were in existence, to detect frauds and errors, to find out whether there is adequate internal control regarding acquisition, utilization, and disposal of assets, to verify the arithmetic accuracy of the accounts, to ensure that the assets have been properly recorded.
Okay, stick a pin for a second, Letitia. So yeah, another list of important objectives. And as you can see, all of these verification processes are designed for audits to make sure that their checks are conducted completely and thoroughly. And notice also, they didn't fail to leave out the issue of detecting frauds and errors. That is always a secondary concern for any audit. Anybody remembers what the primary objective is from part 1 of this class? We know that frauds and error detection is part secondary. What, does anybody remember the primary objective?
Ensure that it is a true and fair value.
Absolutely. Make sure that the information on the balance sheet is true and fair. Absolutely. Good stuff. This thing is actually working. Okay, Letitia, keep going.
To ensure advantages of verification. It avoids manipulation of accounts. It guards against improper use of assets. It ensures the proper recording and valuation of assets. It exhibits a true and fair view of the company.
Yes.
Verification techniques. Inspection. Physical inspection of the assets. That is, company cash in the cash box, physical inventory, inspection of share certificates and documents. Observation. The auditor may observe or witness the inspection of assets done by others. Confirmation. Obtaining written evidence from outside parties regarding the existence of assets.
Yes.
So, Mr. Wilkerson, just a question right there.
Absolutely.
Obtaining written evidence from outside parties regarding the existence. Are we talking then about like insurance certificates and other things?
Absolutely, if necessary. It does include insurance certificates. It does include going back to the supply, the person who the company said they bought it from and say, did you buy it? Did this company buy this product from you? This asset? And then the company will say yes or no. And it does include a question about what was the actual cost of it. Because sometimes the auditors discover, to answer your question, that when they, whether it's insurance or some other entity, that what is showing in the balance sheet is not the original selling price by the supplier. Okay, absolutely. Same thing with liabilities. For example, if the company is owes X amount of money to someone, the balance sheet for the company might say, we owe Apple 15 million. But what the auditor will do is send a private letter to Apple and other lenders from the company and say, what is the balance on this account? And all of a sudden, there's a difference between what's on the company's books and what Apple is saying that the balance is. And that is the kind of discrepancy that needs, in an auditor's opinion, to be resolved immediately. So yes, good question. Keep going.
Verification of assets. The term verification signifies the physical examination of certain classes of assets and confirmation regarding certain transactions. Sometimes verification is confused with vouching, but they differ from each other on the nature and depth of the examination involved. Vouching proves the arithmetical accuracy and the genuineness of the transaction, whereas verification inquires into the value, ownership, existence, and possession of assets, and also confirms whether they are free from any mortgage or charge. The presence of any entry regarding the acquisition of assets does not prove that the particular asset exists on the balance sheet date. Rather, it purports to prove that the asset ought to exist. However, verification through physical examination and confirmation proves whether a particular asset exists without having any charge on the date of the balance sheet.
Thank you so much, Letitia. Well done. A mouthful of important stuff. Equally important is the last point you made about the difference between verification and vouching. It's a great idea to know the difference, not only for test purposes, but for your professional lives. When auditors come in, when you become an internal auditor, when you become some manager of something, it all applies always, because companies are always going to be subject to the world of audit, and you guys have a head start on even some board members around the world who refuse to do such a course so that they can become familiar, because they figure we know it all. We've been around forever, we know all. I don't need to go on a bloody course. Okay, but you guys have taken the time, whether you're auditors or not, to find out how audits work and how important they are. And this kind of information, if you don't get it yet, will serve you well into the future, whether you are aware of it or not. Okay, so be careful. There's a lot of confusion even against practitioners in accounting and auditing. They like to use vouching and verification interchangeably, like they are the same. They are not.
Hello,
Hi,
hello,
hi,
hello,
hello.
hello.
Who's saying hello?
Oh man, who keep cutting in and out?
Indira, we can hear you. We can hear you.
The phone keep cutting in and out. Sorry
I
about
know.
that. I can't hear you guys.
Yeah. We can hear you. You just having issues on your side with the internet, no doubt. Can you hear me
Oh,
now?
I can hear you now,
Yeah,
but it cuts in and out.
yeah. So you until it settles down, maybe a lot of people are on the internet and all kinds of interference from other sources. So yeah, just hang in there until it settles down. Hopefully it'll just settle down. All right. So make sure you remember the difference between vouching and verification. Verification goes after the details of the assets, including any charges or encumbrances, collateral, information
Hello,
against it. And of course, the vouching process, we are told,
hello.
hello? Can you guys hear Indira?
I can
Yes,
hear her.
Yeah,
Yeah, I get it.
we can all hear you, Indira. Keep kicking again another few minutes. Where did you guys go? Vouching, on the other hand, primarily tests for what we call arithmetical accuracy to make sure the numbers are added up correctly. Verification goes way beyond arithmetical accuracy and whether the numbers add up. The numbers adding up is a portion of verification, but not nearly as crucial as making sure that the property exists, that the company owns it, that there are no liens against it in terms of collateral with any banks, etc. Those are the tenets of verification. All right. Okay. Thank you very much, Letitia. Siobhan, are you there?
Let's go.
Okay. Yeah. Verification of assets.
Involving the following steps.
Yes.
All right. Inquiry into the value placed on assets. 2, examination of the ownership and title deeds of assets. 3, physical inspection of the tangible assets. And 4, confirmation regarding the charge on assets. 5, ensuring that assets are disclosed, classified, and presented in accordance with recognized accounting policies and legal requirements.
Hmm.
The scope of verification is wide, and consequently, verification is an important part of the auditor's duty. An auditor should endeavor to satisfy himself as to whether a particular asset is shown in the balance sheet at the proper value, whether the concern holds the title to the asset and the asset is in the sole possession of the concern and free from any charge. If the auditor fails to perform his duty, he will be held liable. In the case of London Oil Storage Co. Limited versus Sarah Hoslock and Co. 1904, Chief Justice Alverstone remarked, "It is the duty of the auditor to verify the existence of the assets stated in the balance sheet, and he will be liable for any damage suffered by the client if he fails in his duty."
See, and this is still, even though that was in 1904, this same battle rages on. There are still auditors who don't feel it's their responsibility to be responsible for the mistakes or mismanagement by management. And to some extent, that is true. However, because you hold the title auditor and you hold the status of being an audit professional, and you are licensed to do this like any other profession, medicine, law, all this kind of stuff, the courts are not interested in too many gripes coming from a professional auditor with regards to their responsibility in terms of the verification process in this case. Okay? And so Alverstone made it clear, Chief Justice Alverstone made it clear back in 1904, and many judges use that as a precedent even today for auditors who go in, do a little blah, 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 come out, and then something collapses in the company, and the auditor says, well, it's not my fault, management messed up. Many courts will still rule, just like Alverstone. Dude, auditor, we don't want to hear your problems. You went in there as a professional auditor, you ought to have noticed or seen, and you ought to have brought it to management's attention. Now, if the auditor does do its proper checks, and they do present the information to management, and then management refuses to follow through, then of course, most courts in the land, including Alverstone perhaps, if he could preside, would say, okay, the auditor is free to go in that kind of situation. They found the issues, they reported it, their job was done. Okay? They cannot make management stop or implement. They can make recommendations, and that is where the audit responsibility stops. Okay? All right, keep going, Jerome.
In addition to its legal importance, verification also plays an important role in guarding against improper valuation of assets like stock and trade, which may inflate or deflate the profit position of the concern. Improper valuation of assets may also conceal the actual position of the business as reflected in the balance sheet.
Proper valuation, yeah. Stick a pin for a second, Javon. Notice we subtly slip from verification to valuation for a moment. Those are two other words that are not used interchangeably either. They mean different things. Verification means checking the existence, possession, and otherwise ownership of an asset, and in some cases, a liability. Valuation, on the other hand, has to do with what? Can somebody make a guess? Valuation.
The value.
Yeah, the value, the cost, absolutely, of the asset. So you could verify the existence, but if you don't verify the value, you've only half done the work. Because the value of the asset is equally as important. Okay? Because that is the number that you want to be properly reflected on the balance sheet.
The question there, Mr. Wilkerson.
Yeah.
Also, with valuation, you also, for some, I guess, some assets, you also look at the, I guess, what you call the market value in case you have not only looking at the cost, but if you have to sell it as well.
Absolutely. Okay. I'll tell you why that's an important point. In accounting, accountants and the accounting profession, we do not record assets at market value. We don't. Accountants are more conservative. And as a result of that, accountants will always record assets at cost, what you paid for it. Now, even though it's recorded on the balance sheet at cost, what you paid for it, it will stay at that original cost until if you decide to sell it. Now, once you decide to sell the asset, then you are free to sell it for any market value that any pool will pay. Okay? And that is the difference between cost price and market price. Okay? The cost price is determined by the selling price when you purchase the asset, and that is the amount that we put on the balance sheet. Market prices, we do not put on the balance sheet unless we put it as a note every year, saying that we estimate the market value to be. But in terms of the balance sheet numbers itself, it's always recorded at cost because cost doesn't change. And accountants do not want a balance sheet that is subject to change every day, like real estate valuations or any other valuation for that matter. And so accountants avoid getting into market values for its balance sheet. It's too inconsistent. But the cost remains the same. You can track it every single time. You can test it and check it. And you only change the status of that particular asset if you decide to sell it. Okay? Very important question again. Very important thing to know again, whether you're an auditor or not. All right, keep on going, Siobhan.
All right. However, it is not possible for the auditor to physically verify each and every asset because time may not permit him to do so, or he may not have sufficient technical knowledge of the assets concerned. It was decided in the case of Kingston Cotton Mills that it is not a part of an auditor's duty to take stock. No one contends that it is. You must rely on other people for the details of the stock and trade. In the McKesson and Robbins case in 1939, we find that the auditor should physically verify some of the assets.
So, in other words, we have on the one end, the auditor doesn't have responsibility at all. On the other hand, with Alveston, you have all the responsibility. Don't come to my court about it's the management's responsibility to verify assets. And then in McKesson, we have a hybrid where, hey, we won't harass you if you don't do all of it, but we will be very concerned if you don't do some of it. Okay? Some test checking. All right, keep going.
Okay. All right. If possible, title documents like negotiable instruments, shares, debentures, and securities are to be thoroughly examined on the last day of the accounting period. He should satisfy himself that the transactions, if any, on the balance sheet date and the date of the audit are bona fide and are supported with proper evidence. The auditor is also supposed to verify stock and trade with reference to the purchase book, the stock records, and the gatekeeper's book.
Thank you very much, Yvonne. So what he's saying here in the last piece is that, hey, come to the end of the year when that balance sheet says the assets are this, the liabilities are that, the auditor had better go and do some checking, some verification to make sure that that information is correct. Because sometimes companies put one thing just prior to the balance sheet date, and if you're not checking it, then they switch it to something else on the very first day of the new business year for one reason or another. So senior management and board members are not always as honest as they should be. And any of you who've been following any international news about buying crashes and company failures and all this kind of stuff, these are the reasons why people are always up to no good. Not all people, just that gang everywhere in the world who makes it their business to be corrupt in one form or another. Okay? And they're hard to weed out. Every time you read some else, some new ones join the bandwagon because they saw the other ones making all kinds of money, being famous for lying and misappropriation, and all this crazy stuff, and they want a part of the action, which is not good. And you'll see in our ethics discussion next week why it's not good. All right. So let's see. Thank you, Javon, for that. Who's next on my? And Dira can't hear anything with that weird internet. So, Shaniqua, are you still there?
Yes, I'm here. I'm here.
Okay, Shanika, great valuation. We move now from the verification side, which you are familiar with now, to the valuation side.
Valuation.
Okay. Now, if I would ask you guys a question on the 17th like this, it is a known fact in the audit world that verification and vouching are the same. True or false?
False.
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 Okay. I hope come the 17th you're just as keen. Yeah, don't let me swing you with certain kinds of questions. Once you do your preparation, you know what you know. Just let it rip. All right, Shaniqua, valuation.
Valuation of assets. Meaning, valuation of assets means determining the fair value of the assets shown in the balance sheet based on generally accepted accounting principles. The valuation of assets is especially important because the overstatement or understatement of the value of assets in the balance sheet not only distorts the true and fair view of the financial position, but also results in distorted profitability. The valuation of assets is the primary duty of the management of the company. The auditor is required to verify whether the value ascertained is a fair one or not. For this, he may rely on the technical certificate issued by the experts in the field. Valuation of assets means not only checking the value of the assets owned by an organization on the balance sheet date, but also a critical examination of the valuation of the value of these assets by conducting a comparative analysis of different assets. The auditor must ensure that the valuation principle for assets is consistently adopted and is based on established principles of accountancy. These assets are classified as follows to determine their value. Fixed assets, number one. Number two, current assets or floating assets. 3, wasting assets. 4, intangible assets. 5, fictitious assets. One, fixed assets. Fixed assets are usually valued at going concern value, which means cost less depreciation. Cost here means the purchase price of the assets plus all incidental manufacturing, buying, and installation expenses incurred to put the assets into use. Depreciation is the provision made for the reduction in the value of the assets based on their usage, nature wear and tear, and obsolescence. Sorry.
Yes, wrong one. Obsolescence, correct.
Mhm. The depreciation provided should be fair. Otherwise, the value of fixed assets may not be fair. Two, current assets or floating assets. These are usually converted into cash at the earliest opportunity in the process of business activity. Example, stocks, bills, receivables, and sundry debtors. Based on the conservatism principle, current assets are usually valued at original value, cost price, or market value, realizable value, whichever is lower. Because they are intended to be converted into cash at the earliest possible time, the value we realize is important. This method is adopted to strengthen the financial position of a concern by indirectly providing for expected loss by way of a fall in the market value of the assets. This principle is the conservatism convention of accounting, which means we do not expect profits, but provide for anticipated losses.
So you guys are picking up a few little accounting concepts along the way. Yeah.
Yeah.
Accountants, we love the discussion of profits, but that's not the accountant's primary love. That's management, senior management to talk about profits because that's why they're in business to begin with. Accountants, on the other hand, we understand profits, but we keep a very low profile on the profit stuff because we want to make sure that nothing happens in the business to manipulate profits. In other words, sometimes management will put false information on financial statements to show higher profits so that they can get bigger bonuses, etc. And so when auditors come in, they're looking at these kinds of things. And so profit is not a motive to direct the auditor. What the auditor really wants to know is what are the potential losses? Because the auditor knows that a discussion of losses and a knowledge of losses will determine whether the company succeeds or fails. Okay, by how many losses you incur, more so than what your profit line will be at the end of the day. That's why when you work for companies, when something goes wrong, the first thing they do is send people home to save money to cut their losses. And payroll tends to be one of the most significant expenses for any company. That's why they like to lay people off. Because when they lay a bunch of people off every month, they get to save that money. They don't have to pay anybody. And so now they have additional money to do whatever other crazy stuff or hopefully important stuff that they need to do. All right, keep going.
Number three, wasting assets. Wasting assets are those assets which lose their value gradually based on their use. Example, a mine and a quarry. Question, what does this mean here, mine and a quarry?
Aha, man, that's what I love it. When you stop and say, what the hell is that? Okay, way to go. Anybody Google? Quarry, what is a quarry?
That's like a pit thing. This has to do like with mining, it is mining and quarry, like a pit or something like that.
And what do you think might be in the quarry or mine?
Like
The-
valuables like diamonds and stuff
Yeah,
like that.
Stuff like
yeah,
that.
valuable things like diamonds and rubies and
Mm.
oil and all that.
Aragonite, those things.
Yeah, aragonite, like in Jamaica. See, that kind of stuff can exist in a mine or a quarry by all means. And
Mm.
reason why we call them wasting is not because they're being wasted. We call them wasting assets because every time you dig some out of the ground, you leave less and less in the ground, correct?
Right.
Yes.
That's what the term wasting means for accounting purposes. Okay. So great question. I told you, you pick up a whole lot of other stuff that is always good to know for whatever reason that may not even be related to audit whatsoever. Okay, that's the beauty of it. All right, keep going.
To value these assets, we should determine the usefulness of the assets in terms of units of production. And based on their actual use, the value is to be reduced on a proportionate basis. If in a particular period this type of asset is not used, then the value may not diminish. Thus, these assets are to be reduced on the basis of consumption. When it is difficult to adopt this method, then the cost less depreciation principle may have to be applied.
In other words, if you have diamonds in the ground this year and you don't take any out, at the end of the year, your valuation for diamonds should be roughly the same at the end as it was at the beginning, correct?
Yes.
However, if you take out a whole bunch of diamonds during the year, then your valuation for what's left in the diamond quarry or mine should be less than what you had at the beginning of the year. That's really what that whole concept is about. Okay. All right, keep going.
Number 4, intangible assets. Usually intangible assets like goodwill, patent rights, and intellectual property are valued on a cost basis. But if the same are acquired by a non-cash transaction, then the fair market value is to be taken as the value of intangible assets. The auditor should also review the period that it is fully written off and ensure they are shown as assets because they do not have any realizable value. They are to be valued at actual cost less the amount written off as appreciation as at the balance sheet date. Number 5, fictitious assets. Certain lump sum expenses which provide benefit for more than 1 year when incurred are written off over a period of time. Until it is fully written off, it is shown as an asset in the balance sheet. Example, preliminary expenses and discounts on issue of shares. These are all fictitious assets because they do not have any realizable value. They are to be valued at actual cost, less amounts written off as at the balance sheet date. Valuation methods. The following are the various principles for the valuation of assets. Number 1, cost price, going concern value. Under this method, the actual cost of assets are reduced by the depreciation provided. Usually this method is used to value fixed assets. 2, market value. This refers to the market value of the asset, i.e., the price at which the asset is being transacted in the market. This is used to value current assets only when this is lower than the cost of the asset. Usually market value is adopted to value items that are perishable in nature. 3, scrap value. Assets which are useless for the enterprise may be sold as scrap in the market. The value for which such assets can be disposed of as scrap is referred to as scrap value of assets. 4, replacement value. This represents the value at which the existing assets can be replaced. That means the price to be paid to acquire such assets in the market on the date of the balance sheet. 5, realizable value. The value that can be obtained if the asset is sold in the market, i.e., anticipated selling price. Usually, expenses such as commission and brokerage fees are deducted from it.
So now you see, you guys have a whole bunch of different types of assets that you need to know, because you know I'm going to ask you to list and describe a couple of these assets, fixed and intangible and fictitious. They're not hard to know. You just need to learn them. That's the crazy thing about learning. You have to actually learn it. All right. The second thing that is you should note is that I will be asking you about valuation, hint, about valuation methods, so that you would need to know the difference between cost price and market price. you need to know what scrap value is. Okay, stuff that the company doesn't need anymore, it's just sitting around. The problem with scrap value is it doesn't mean it doesn't have any value. But some people like to buy scrap that is no longer useful for the company, but they could find something to do with it. So companies sometimes keep their scrap and sell it as people are interested. The only problem is auditors need to keep track of scrap value to make sure that the scrap value isn't being sold and the money going where.
Pocket it in your pocket.
Yeah, and some employees pockets. Oh yeah, I want old machine and we don't use that. $50. And they sell it for $50, keep the money, don't keep a record. What they should do is have a record of the scrap value, and auditors should be checking it to make sure, even though it's scrap, they're making sure that the stuff still exists. Because if there's shortages, then so obviously somebody is running off with it as usual. All right, so you want to make sure you know the differences between these different kinds of values and these different kinds of assets. All right, keep going.
Auditor's position regarding valuation of assets. It has already been pointed out that the auditor is not supposed to have technical knowledge regarding the valuation of assets. Therefore, he has to depend upon the valuation made by the directors, experts, and surveyors. But does it relieve him from liability if certain assets are overvalued or undervalued by the directors, experts, or surveyors? The answer is no, because the auditor cannot provide a guarantee for absolute correctness when he must depend upon others. And where assets are valued according to the estimated depreciation, he can still be held liable. He must ensure that management seeks to show the fairest possible estimates regarding the valuation of assets. Under these circumstances, the auditor should see that assets are valued according to certain accepted principles of accountancy. He should check the estimation to determine if it is reasonable. The auditor should thoroughly examine the available papers and documents to arrive at the correct value of assets. Where there is suspicion regarding the valuation of assets, he should investigate further. Distinction between verification and valuation. Number one, meaning. Verification establishes existence, ownership, and acquisition of assets, whereas valuation certifies correctness of the value of assets and liabilities. Two, time. Verification is done at the end of the year, whereas valuation is done during the year. Three, personnel. Verification is done by the auditor, whereas valuation is done by the management. Four, evidence. Title deeds and receipts of payments constitute documentary evidence for verification purposes, whereas certification by management is the documentary evidence for valuation.
Thank you very much, Shaniqua. So now, in those last pages alone, I have dropped some hints about some things you really ought to know that can get you some extra points coming down the stretch. So make sure you know those different assets and what they are, the different valuations and what they are, and the difference between valuation and verification. And you can get yourself a whole lot of easy points just by being familiar with them. Okay. Quite a few hints tonight. That must mean we're getting closer to the end. Okay, so we're going to break there. Next week, when we come, we will talk about some ethical concepts in the audit. I'm only going to do as much as I think you need for introductory purposes. I don't want you to become inundated with a lot of the gobbledygook, but there are some very important initial things that you should know about ethics in general, and certainly ethics with regards to audit and ethics with regards to how the auditor should behave in conducting his professional practice of auditing. All right, so we'll look at those next week. In the meantime, you have a holiday weekend coming up. For students, that is not a holiday. That is time to prepare for examinations, to study, to stay in your pajamas, to not go out and have any fun, None of that stuff. Fun is for people who are not in class this holiday weekend. So if any of you decide to go out and have any fun, you should feel guilty. How's that? No
Noted.
comment.
Noted.
I can hear somebody saying, I don't care what you say. I'm doing whatever I feel like this holiday weekend. Nobody's telling me what to do, including you. Just thought I'd throw it out. All right, but whatever you guys do, be safe. Please study. Please review. Do a little at a time so you don't have to rush. And we'll talk about our final lecture next week with regards to audits and ethics. Okay? Yes?
Okay.
Wonderful. You guys take care and I'll see you soon.
Okay, thank you.
Okay, you too.
Good
night.
night.
Right. Good night.
Good night.
Bye. Letitia, can you hear me now? Huh?